Hello and welcome to the Harwood Report for April 2nd, 2018. I am Keith Harwood, the founder of Trade Academy and the host of the Harwood Report. As always, we start with the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read the remaining disclosures posted here and remember that options have risk. All right, folks, it has been chop for feels like 2 months now. I mean, really, starting on that February 5th sell-off, the market has been dying to find direction. And in the last week, it has been an alternating sequence, up one day, down the next, up one day, down the next, and it has been very difficult for the market to know where it's going next. Let's look at the charts here in a moment, and I'll talk through where I think these markets can go and how I can trade them. Talk a little bit about bonds because they have started to form maybe a little bit of an uptrend as people look for a risk-off, risk haven. Speaking of risk-off and risk havens, gold is firm again today after having a fairly weak end to last week, and finally oil is very weak today as it's been one of the big longs for speculative positioning. Some of that seems to be unwinding today at the start of a new quarter. So let's get to it. First off, fear and greed. As I've been stating for the last couple weeks, I think this extreme fear metric is way too excessive. I don't think the market should be in an extreme fear mode given what's been going on fundamentally. There has been some additional changes to the fundamentals from basically what's going on in the political landscape with tariffs and whatnot, but that doesn't seem to be enough to drive the extreme level of fear. Perhaps what is driving that extreme level of fear is frankly just the fact that the market can't find direction, the volatility stays dead, and there's nobody there trying to catch falling knives. That's what we're seeing here with breadth, for example. Scroll down here a little bit. Stocks making new 52-week lows. And advancing declining. So when I look over here, actually, so they put it in this right here, the stock price strength. A lot of stocks making new 52-week lows, not so many making new 52-week highs. Of course, when we've pulled back from the 52-week highs to the overall market, it's tougher to find names that are making new 52-week highs. But there's nobody catching the falling knife on some of these weak names. Seems like there's a lot of people maybe out there saying, I'm going to wait until the market turns around and then I'll buy. So in the meanwhile, algorithms function in a way such that they basically search for stops. Presses the market lower, they don't find as many more sellers, that starts to press the market higher, find no more buyers, and we stay in this choppy range. And so that is what we see right here. There we go, in the S&P chart. This last week in particular has been a crazy chop fest. Today, the market is hunting for a new direction, and that direction is down. In February, on the break, February 9th, touched just below the 200-day moving average and bounced back aggressively, finishing the day green. On March 23rd, the market got down just below the 200-day moving average, and the next day started creating what, looked like maybe a bottoming formation. Higher high, higher low. Next day started up near the highs, and of course closed right, touched back down to the 200-day moving average and closed right above it. Again, closed above the 200-day moving average. Looked like maybe we would firm on Friday, and then today opened here near the 10-day moving average, and now trading near, not at, but near session lows and below the 200-day moving average. This is a concern for the market, but I'm honestly not fully sold on today's move for one particular reason. The global marketplace isn't fully open today. So I want to see this confirm with another day below the 200-day moving average. Right now, the way that we're chopping, we've had too many of these false breakouts and false breakdowns. Didn't happen. So we've been chopping here between the 200-day moving average and the 10-day moving average. For me to get bullish, I need to see a close above the 10-day moving average because that's clearly been a resistance point here on the upside. For me to get more bearish, I need to see really 2 consecutive closes below the 200-day moving average because that then starts to tell me that, you know what, there's nobody supporting the market down here anymore. They've given up. The long, the bull, the plunge protection team, whoever it is no longer all that excited about buying dips. They weren't that excited about buying dips here, obviously. They seemed like they were getting more excited, and then bam, that closed back below the 100-day moving average, creates this chop zone between the 100 and the 200, and now we're closing below the 200 more than likely today. But since there's been so much chop, it's hard to get that conviction on this breakdown. It could just be a bear trap, like we've had bear trap and bull traps over and over. Look where we were here. There was no reason necessarily on a fundamental or on a technical basis to sell off. No reason on a technical basis to sell off as we press to these highs. There's no reason for us to buy back on a technical basis when we get to this low, which means it's more of a trading market. And I tend to advocate for a trading market when we get down to these lows and a trending market when we're closer to the highs. And right now it feels like a trading market. And the real reason is these big ranges. Today's range, as you can see, is almost $7 in S&Ps. So if I wanted to play for a move from the 200-day moving average to the 100-day moving average, I'd be playing for about a $10 rally over time. Or I can look at the day's range and say $7 in one day is a much more tradable, short-term, whatever, range trading market than looking for a new trend. The new trend for me gets set if and when I get confirmation of this bearish setup or confirmation of a new bullish setup, and that again above the 10-day moving average for me on the close, or a couple of days below this 100-day moving or 200-day moving average. That wedge is tightening. This steep downtrend, and then this kind of level here right around the 200-day moving average. This zone, we'll call it. I want to go over to the other sectors. And then I'll talk a little bit about how I use that trading range to trade. In particular, I'll focus that on IWM today. But in the Qs, looks similarly weak, but again, this is still above the 200-day moving average. The Qs haven't had as much seeming attraction to the moving averages. The S&Ps have been very much focused on the moving averages for a lot of their resistance and support levels. Qs seems, to basically be taking some cues, no pun intended, from the S&Ps. But if we go to IWM has been actually falling slower than the rest of the market really here. I mean, it dropped down from 160 to 149, so yes, it had an $11 break here from these highs at the middle of March. So that's about 8%. SPY, as a reminder of the magnitude of that drop, has dropped from 280 to 256. So 257, sorry. So I guess 8-9%, same, or 8ish%, about the same amount there, maybe 9%. The Qs have been the big sell-off, the big liquidation, dropping from 175ish down to 155, so $20. So we're talking about closer to 12%. This is where the liquidation came because of all the negativity around Facebook's data, Tesla's situation, Amazon and maybe their data situation as well, being correlated to Facebook, as well as the negativity coming from, sort of the expectations of what the White House tweets about Amazon are going to mean. The Qs were really the leader of the market on the way up, and right now have been leading the market down. It doesn't mean that they will lead the market back up. A lot of times we find new sectors to lead the market after a big washout like this. And I've been talking for a while about how the Qs had gotten a little bit ahead of small caps, and it seems like that trade is probably done now about the Qs versus IWM. I want the market to tell me who's going to be the next leader up. And right now, there's no clear answer to who is going to lead the market higher. All right, so let me talk a little bit more about the trading range philosophy here for me in IWM. You can see here that IWM is testing the 200-day moving average, and that seems to actually have been a decent level for support here. So this is going to be an inflection point for you, right around 148. Notice also here that the lows here, a little bit above 148, and again, the lows here were on the 200-day moving average. So I like 148 as an inflection point. I go over to the volatility landscape. Why is this not minimizing? There we go. I go over to the volatility landscape, and I look at the S&P, 20.5% for 30-day implied volatility. IWM is the same at 20.5%, and the Q is 28%. Historically, I see that volatility in SPY. Let's take the highs around, say, November, just to give me a longer term perspective. It's around 11%, just under. The highs in the Qs back in that time frame, we're looking at around 15.5%. So about 50% higher than the SPY. So 1.5 times the SPY level. That's pretty close to in line with where it is today, 28 versus 20.5. And IWM was trading closer to 15% as well. So in a long-term volatility basis, I can say that IWM looks to be the cheapest vol on a vol basis. Even though it's high on a recent history, could get back down to 14. If the market continues to liquidate, this should maybe start to play some catch-up, especially if IWM now starts to sell off a little more. Maybe the Q's liquidation's over and everything just falls in line with its normal historical levels, which would mean IWM falls faster than SPY. Well, that means IWM falls too cheap, and it would mean that IWM falls about as fast as the Qs, which means IWM is too cheap relative to the Qs. And I'll note when I go to IWM, and I look at, say, April 20th, 3-week options. The 148 straddle there. Let's clear this volatility. It's around $5.80. So my break-evens are below around 142 and around 154. So I go back to my chart here. 142. Yeah, if we break below the 200-day moving average and liquidate, that seems like it's going to happen. Reasonably speaking, why wouldn't we retest the February 9th lows, if not fall farther? And if that happens, volatility should pick up. And if we find support around here, around this 148 level, and rally back, 154 seems pretty reasonable as well. I've got the 100-day moving average here, 153.20. So all of this tells me that if the market goes back to the normal, from this inflection point to the next logical inflection point, either the lower or the higher, my straddle breaks even. If it happens faster than 3 weeks, I will make some money because there will still be extrinsic value in that. So that is how I want to look at this right now, is my trading range allows me to look to be long an IWM April 148 straddle. I also prefer 148 because that's going to have a small long delta. If the market firms, volatility is more likely to come down. So I want to get away from my straddle faster. If the market falls, volatility should come up. That means that I still want it to be, along a little bit of delta. That actually hedges my Vega risk. So what I'm looking at here is an IWM April 148 straddle for, the mid-market on this is, again, 580. 580 is not overly priced given what is likely, in my opinion, to happen. I don't expect us to sit at the 200-day moving average. I expect the market to move away from it. And in that process of moving away, it will allow for that straddle to appreciate in value. Similar kind of metrics can be applied to SPY and the Qs, but because those volatilities are higher relative to where IWM is, I actually look for shorter duration on that. And I'll talk about that more in the premium newsletter that I'll be sending out in this afternoon. Let's move forward. TLT is another spot where I can talk a little bit about this setup. So first off, we were in no man's land for, a month. False breakout, pullback, and now looking like a breakout again. So this is looking like a fairly bullish setup. And remember that this break on February 1st was the one that started everybody getting scared about the market. We said, oh my gosh, if rates rise, that could destroy the market. And that was with TLT at 150 or 122. And guess what? We're back at 122. So rising rates have now been removed from that equation of causing a market crash. That also leans me a little bit bullish on the market because you can't take yields are going to rise because that's not being priced into the market anymore. There's not a fourth rate hike being priced into the market anymore if we're trading back at the level we were before that fourth rate hike started getting discussed a little bit more aggressively. And again, in TLT, similar to what we saw in IWM, this volatility is not all that expensive. Back in November, implied vol was around 10%. Right now, implied vol is around 10%. At the peak, in that February break, implied vol got up to 16%. This volatility is trading more in line with where it has historically. Why wouldn't I be long some vol here, given what's going on in the rest of the world? So last week, I looked at this and I thought to myself, you know what? In this case, I'm going to again look for a straddle because I don't know who's going to win out this week. The market hasn't told me yet. So I look at the May 122 straddle and I say for $3.67, that's too cheap. And so let's look at where 122 plus 367 gets me. Either 125.67 back up into this consolidation area, or if it breaks and we go back to 118, this is more than $4 in the money. And I've got 2 months on this instead of 3 weeks. So I've got a lot of time for this kind of scenario to play out. And it makes sense. Either we start talking about that fourth rate hike again and yields rise and the market recovers and everybody else is happy and they say, you know what, this makes sense. We can push the market down to 118. Or we say, you know what, there's really no chance of 4. 3 is even questionable and we move to 126. So again, I think this gives me a lot of time for a lot of fundamental information to come into the marketplace via new non-farm payrolls numbers, clarification on the Chinese tariffs and everything else. And so if I can get 2 months of a straddle for $3.67, this is cheap. And so that's how I, again, am looking at this sort of stuff, is where is my best trading range opportunity? Where can I buy a cheap straddle? And so far, I think IWM and TLT are more logical than some of the others. All right, and I am going to run through now a little bit faster on some of the other products because these are similar but different. All right, so dollar yen obviously has been my trigger for gold, and it's weak today because the market's weak. More importantly, all you can see here is there's just been a ton of chop in dollar yen. It's hard for gold to find a direction. So gold has been chopping a lot. You really see it this past week. It's back near the highs as dollar yen starts to weaken here. Will it break out above 129? That is yet to be seen. I think if the market can recover, gold should fade to 124. And if the market can strengthen, if the market continues to weaken, that risk. So as I think about that, I again can go in here and say, you know what? Volatility, which is up today, is no longer quite as cheap. It's still pretty cheap in gold. And I can apply the same logic to silver and the miners and everything else, but I'll focus on gold for now. And because vol's up as much as it is today, I'm going to look towards April 20th again and just note that the 127.5 straddle is $2.60. So if that's 260, that gives me down to 125 or up to 130 as my necessary move in the next 3 weeks. Or put another way, today's range in gold is from 125.79 to 127.34, so about $1.60. I'm going to get a $1.60 range every day. It's 1.2%. I should be looking at a greater than 16 vol in this product, and it's at 11.5. So while it's not as cheap as it was yesterday in terms of volatility, this straddle at 260 is still very cheap. So I'm looking at that as another way to play these large trading ranges. And then once the market tells me whether we're going to go bearish equities or bullish equities, and it may happen this week, it may happen next week, it may not happen for a month, then I can start looking for directional trending trades again. But right now, it's more about where is the volatility too cheap on the macro space. And I'd say it's IWM, it's TLT, it's GLD. All of these are too cheap relative to where the other stuff is. Doesn't mean I can't make money being long an S&P straddle or long a Q straddle. I think I can make more money, though, being long a TLT straddle or a GLD straddle or an IWM straddle. I'll talk more about silver and miners and everything in the newsletter as well, because I wanted to move to oil. So we can see that oil got washed out today, in part driven by what's going on the macro basis. So everybody is selling oil as another risk-on asset while they're selling equities. This pushed oil back down here towards, I don't know, I guess we could call it the recent range midpoint, even though there's been some washout potential down here towards the 100-day moving average. And I do think that if the market continues to liquidate, we may see oil push back down here towards 1220, so another 4% down. But if the market stabilizes, I'm looking for oil to firm. And again, I think that that creates an explosive potential for OIH, which is now pressing near the lows and looking like it could fall off a cliff. So I don't catch the falling knife while USO is breaking, but if USO firms, This creates an explosive potential upside here into the 27-28 range. Or XLE, same idea. XLE has been getting good ranges here the last few days as well, and that could easily press back into the 70s or higher. 74, 75. Into the, I would, if and when oil starts to firm and the market starts to compose itself, I'll be looking to play XLE back or into the low 70s. Right now, volatility's picked up a lot in these names, so I'm looking to wait on oil. I don't believe the market will want to press and punish these energy names down here below these lows, and part of the reason is because these lows at 62 bucks in XLE were made when USO was trading closer to 9.5 bucks. If I look at it on the crude future, the market was trading in the 45 range. So fundamentally, I struggle to see why you would press all of the oil producers, oil services companies, etc., down to lows with crude oil trading 30% higher, 40% higher than where it was when they were at their lows before. I think that based on just that metric, those value investors will start looking heavily into energy if those levels start to get breached. But because people don't like catching falling knives anymore, people used to love catching falling knives. It was like, oh, I'm getting to buy stuff on sale. And I think people have been punished for that mentality. And everybody now knows that you get punished for that mentality. And that's probably what's been holding oil names from making those, pressing back towards highs or finding value investors. People tend to like technical and momentum trading instead. So again, what I'm looking at then is as oil firms, I'll look for bullish setups in OIH and XLE. And just, it's not quite ready yet. I mentioned the Harwood Report. I will talk through, in the Harwood Report in particular, what this means for SPY and the Qs, given what I talked about on IWM. And I'm going to talk more about those gold setups, as well as gold, silver, gold miner setups, as well as those energy setups, because I think there is an interesting trade there right now. It's just not the aggressive knife or falling knife play for max rally moves. There are ways to actually get a lot of leverage by using spreads and that sort of trade, and I'll talk through more of that in the newsletter that'll go out this afternoon. If you're interested, it's free for the first month. Go to tradeacademy.co/Harwood Report, sign up there, and you'll get the first month for free. If you find extra value out of that, then that'll be $49 a month going forward. But again, first month's free, so there's no real risk here to you. Feel free to contact me, Keith, at tradeacademy.co, or by phone 312-600-8004. Thanks for listening, and I will talk to you all later. Have a great rest of your week.